So I guess today you probably feel like we've done to death revenue, leases, financial instruments, but we are finding that entities are still not prepared. So we're going to focus a lot, or I'm going to focus a lot on the leasing, because we haven't done that recently in the sessions. We've been focused on revenue. However, before we get onto it, I just want to give you a bit of an overview of what we've seen happening in the financial reporting space, both by Treasury and also by the AASB. So if you've missed it, Treasury have changed the large reporting limits. So the large proprietary thresholds have now all been doubled. It came out very quietly. There was no major media release. It just kind of snuck through just before we went into caretaker period. Interestingly, they did decide to double every single threshold. Previously, when we've had the doubling, they've left employee numbers alone, but we now have greater than 100 employees. So if you meet more than 2 out of these 3, or 2 out of the 3, you are now a large proprietary. It is expected that about 1/3 of entities will drop out of being large. However, there are some things you need to bear in mind. When you calculate these numbers, they have to be calculated in accordance with accounting standards. So if, for example, you have a significant number of leases, I'm going to tell you how you're going to put extra assets on your balance sheet, so the right of use assets. So your assets, and bear in mind that says gross assets and not net assets, are going to be increased. You need to include the right of use numbers in calculating these. So you may think that you're out of it, but actually when we adopt these standards, changes to revenue, changes to leases, you might actually sneak back in again. So just bear that in mind. It's effective from 1st of July 2019, which is your 30 June 2020 financial reporting year. Bear in mind when I talk about later on about special purpose accounts, this increase in the threshold, we did talk at the AASB to Treasury. We didn't necessarily encourage them to double it. We wanted them to have real objective evidence of what the thresholds were going to be and who they wanted to report. But given that this has doubled, we actually believe that entities who are now large probably going to be quite hard to argue that you can do special purpose accounts, that you can do non-reporting. So we are doing some changes to mandate that I'll talk about next, but this threshold probably means that even for your 30 June 2020, you are going to struggle to do special purpose accounts. So let's have a look at what we are proposing to do. As you're aware, I've talked about it before, we are planning on removing many entities' ability to lodge special purpose financial statements. As an interim measure, we are about to issue an exposure draft. I say it's an interim measure because we've realised that many special purpose financial statements that are lodged, you actually have no idea what standards they've complied with. They'll put in comments such as, we've complied with the mandatory standards. But what does that actually mean? Or we've complied with the relevant standards. Again, what does that mean? So we're proposing an exposure draft. It will have an effective date not at 30 June 19, but we are encouraging entities to early adopt this. And what we're asking entities to do is to tell us whether they have complied fully with recognition and measurement within the standards. So if you are preparing special purpose accounts, we want an explicit statement on whether you have fully complied with all recognition and measurement criteria. If you haven't, tell us either what you have complied with or what you haven't complied with, whichever is the shorter list. If you've done lots of compliance, you just maybe haven't done deferred tax, well, it's easier to say that. If you've only complied with deferred tax, it's easier to say that. So we want to be able to read financial reports and understand what you've done. In addition, if you are a parent entity, we want you to tell us whether you have consolidated. And if not, why not? So we know that there's people out there who think consolidation is a presentation standard, and therefore we often have the shell accounts being lodged or the single entity accounts being lodged. At this point in time, as an interim measure, we're not mandating that, but we want some clear information within the financial statements about what you have or have not done. So likely to be effective, probably 30 June 2020. We might try and get it through for 31 December 19, but certainly we're encouraging everybody at 30 June 19 to put this information in. You don't have to change anything, you just have to tell us what you've actually done. So just be aware that that will be coming out there. We are actually accelerating it quite quickly because we don't think it's onerous for entities to do it, we just think it's better communication for the users. So the reason that's an interim measure is because we are still very strongly going ahead with our proposal to remove the ability of lodging entities to prepare special purpose financial statements. At this point in time, our focus is very much on the for-profits. We will do the not-for-profits, but the timing's a little bit later. So we are issuing the revised conceptual framework, so the revised international framework for publicly accountable entities. It is sat in my inbox to be voted on, which has just reminded me, I think I meant to vote by today, so it is imminent that that is going to be released for publicly accountable entities. We are then going to look at some guidance about who is a publicly accountable entity. So for most, it's obvious. It's if you're listed, if you're a financial institution, but around the peripherals, there is some uncertainty about who might be captured. For most of you, I don't expect it to change. It's some obscure entities, often in the banking space, around some securitisation funds, that they don't necessarily believe they are publicly accountable, whereas other entities believe they probably should be. So we will do some more guidance on that. The next phase is to adopt the revised conceptual framework for other for-profits who are required by legislation to prepare reports in accordance with accounting standards. So hence a lodging entity in that for-profit space. What we will do is we are going to issue an exposure draft that proposes that if you are required to prepare financial statements in accordance with Australian accounting standards, you will be doing general purpose accounts. There will be no choice, there will be no am I a reporting entity or am I not. It will be full compliance with recognition, measurement, consolidation and equity accounting. And in relation to disclosures, we are going to issue a separate disclosure standard. That disclosure standard will be based on the IFRS for SME disclosures. So what we did with RDR is we took all of the major accounting standards, all of the full accounting standards, and we knocked out disclosures, which meant it was a top-down approach. Now what we're looking at doing is starting at IFRS for SME, which is a much lower level of disclosure, and we say, is the recognition and measurement the same in IFRS for SME as it is for full IFRS? If the answer is yes, we'll take the IFRS for SME disclosures. If the answer is no, we will then say, how do we need to change the IFRS for SME disclosures to reflect the different recognition and measurement? So we're expecting those disclosures to be much lower, and that will be our tier 2. So the current RDR that we have, we will scrap. We will replace it by a new tier 2, which we believe is going to be less work. So when you're moving to your general purpose, it will be those tier 2, less disclosures, but full recognition, measurement, consolidation and equity accounting. In relation to the effective date, at our last board meeting on the 30th of April, we have decided to aim for an effective date for periods starting 1st of July 2020. This is 30 June 2021. That is not very far away. The reason that we've come up with that date is it's actually a year earlier than we were initially proposing. We have given relief against comparatives. So we were going to do 30 June 2022 with full comparatives. We've actually pushed it back to 30 June 2021 with no comparatives to try and get this through a year earlier, because we absolutely believe it's something that should be in play. Bear in mind what I said about the increase to the large proprietary. If you are still a large proprietary, you're going to be really struggling to argue that you are a non-reporting entity and it's not reasonable for the existence of users. So therefore at your 30 June 2020, you're probably going to be wanting to do general purpose. We are aiming to have this out for early adoption at 30 June 2020. So that's where we stand at the moment, fairly hot off the press information. As I say, it was done 30th of April that we came up with this revised time frame. I think we would struggle to actually push this any later. The board is really quite adamant, and we think that entities who are now lodging should be in a position to do this general purpose. So I don't expect the date to be pushed out. I genuinely expect this is the date we'll be working towards. Any questions or comments, Darryl?
How different will be the RDR disclosures versus the new reduced disclosures?
I haven't actually seen it at the moment. I have to admit I haven't gone through IFRS for SMEs and looked at the disclosures. I think they will be worded much simpler, which I think will be helpful. I think in some areas it probably won't be a lot of change. In other areas we will be able to knock out a lot of that information. We're definitely expecting them to be significantly reduced from where they are. And the other thing that will be really helpful is they're all going to be in one standard. I don't know how many of you do RDR, and if you try and work through all of the standards and figure out which disclosures you're meant to put in, it's not easy at all. Whereas having them all in one place is effectively your disclosure manual that you can look through those. So at this point in time, it will vary depending on the different standard. When the standard comes out, it will have everything in there. But hopefully it's much less work than RDR. Yeah, yeah. Any other questions or comments on that? Oh, all right. So let's move on and start talking about the leasing standard. I have been saying that I got much more engagement in the leasing standard than I do in the revenue standard. And that's because I can tell you in a couple of sentences what the impact of this standard is. Leases are going on balance sheet. The revenue standard, my answer, as you know if you've heard me talk before, is it depends. And that's why it becomes hard. Having said we've got more engagement in this standard, scarily, we are still seeing most entities not being prepared for this standard. So this standard kicked in from 1st of January 2019 for December year ends. So those of you in the room who are Decembers, we should have been doing this standard for almost the last 5 months. I'm not going to ask how many of you have. For June's, we should be doing this from 1st of July 19. What I'm finding is entities, when they've been doing their budgets, haven't even factored this standard in. So what that means is you're doing your management accounts on the same basis as your budgets because you don't want a difference between your budgets and your management accounts. And then we get to the half year for those of you who are listed, or the year end, and we have a completely different set of numbers. We are going to be providing one set of numbers in our statutory accounts to be audited, and we've been reporting a different set in the management accounts. Most people who are reviewing your management accounts, your boards, your management committees, whoever that is, aren't necessarily hugely financially literate. And to say, we've been telling you it's this set of numbers, yet at the year end we've got a completely different set, that makes everybody feel really uncomfortable. So we have to think about how we're going to manage towards management accounts, budgets and statutory accounts being different, what communication is going on. Those of you in the room who are listed, we will be seeing this for the first time in financial statements of 30 June 2019 at the half year. Haven't seen very many, if any, entities in Australia have adopted this yet. There's been a few overseas, but very few entities have early adopted this. So really 30 June 19 half years will be the first time we see the Australian entities jump on board with this. So my first comment is trying to figure out what is a lease. This is one of the biggest issues with this standard. Now it sounds easy. You go to your leasing folder and you pick up your leasing folder and you say, well, these are all our leases. However, what we need to think about is what's not in that folder that should be. Many of you in the room may be external auditors, myself included, and we always had it drilled into us about the completeness assertion. If you want to know your client's got everything included, you don't look in the leasing folder, you look outside the leasing folder, and that's what you guys need to do. This definition of a lease is quite different from the definition that we used to have in the old leasing standard. It's not that different from the definition we used to have in 2 accounting interpretations. The problem is we put something in an accounting interpretation and it gets ignored. So if we look at this definition, it's a contract. So contracts can be written, verbal or implied. Conveys the right to control the use of an identified asset. So who's actually got the right to control the use of the asset? This standard all about control, not risks and rewards anymore. I am only going to talk about lessees because from a lessor perspective, nothing significantly has changed. So we've got still the 2 models. We've got a lessee model and a lessor model. So controlling the use of an asset, it's an identified asset. When we're looking at an identified asset, does the lessor have the substantive substitution rights? Can they swap that asset for whatever economic reason they decide to swap it? Or is it your asset? If we were to take a building, for example, we're leasing the 19th floor of this building, fairly certain HLB aren't going to turn up for work tomorrow, and the landlord says, surprise, you're actually on the 28th floor today, and then the following day they're on the 16th floor. It's explicit, there's no substitution rights for this particular asset. If we drill into this definition a bit more, 3 components. Do we have an identified asset? So as I said, explicitly or implicitly identified. We can also have a capacity-based asset. If I'm using a pipeline and I'm using 80% of the capacity of that pipeline, that's potentially a lease in place over that asset. If I've got IT outsourcing and I've got the black box server and I'm using specified racks within that server, potentially that's an identified asset that I've got a lease over. If I've got outsourced maintenance for some of my infrastructure and those vehicles that are being used or the equipment that's being used is very specialised, can only be used for my particular infrastructure, potentially I've got a lease in place over those particular assets. So we've got to try and look and understand what agreements might we have in place that meet the definition of a lease. Yeah?
Is there a materiality cover?
Materiality always exists. There is a low value asset exception, which I will talk about a little bit later on. So you can still have a situation where you're not doing lease accounting, but it's identified as a lease. So in the identification, we identify all of those agreements that are leases, and then we look and say, can we carve them out? Does the lessee obtain substantively all of the economic benefits from the use of the asset? If you've got exclusive use, it is deemed that you do, because nobody else has it. But you don't need exclusive use to have a lease if you've got substantially all of those economic benefits. And that's why I used, for example, the 80% capacity within the pipeline. Do we have the ability to direct the use of the asset? So if it's a vehicle, can we decide what's being driven in that vehicle and where that vehicle's being driven? If it's an office, can we decide which office services we are going to run from that particular facility? Do we have the ability to direct the use of the asset? If we have all three of them, we answer yes to all of them, we have a lease. It could be that only a small component of it is a lease, a part of a bigger contract, but we have to deal with that because potentially it contains a lease. How do we identify these? I've had one client who said to me, can you review my policy paper? And generally their policy papers are between 3 and 5 pages long. This one was 63 pages long. They're very much like telling a story, which is what I always tell people to do. And they described in great detail how they'd gone through the process of identifying these leases. So it gives you a good example. What they've done is they started off going through the general ledger. And they said, it's a recurring amount. That's what we're looking for. If it was a lease, it's something that we pay pretty much every month. So they started off looking at those recurring amounts and said, okay, that's part of our population. Then they had a look at all contracts that they'd put out for tender over the last 5 years. Because they said, let's have a look at any of those and see whether they potentially meet this definition. They looked at their contracts register. Could any of these meet the definition? And then they went outside of the finance team and talked to people. They actually went out to the heads of the different divisions and different departments. And they said, this is the type of thing we're looking for. Do you have any contracts under your management that could potentially meet this definition? So they started with this really large population of potential things. They then worked through this and knocked them out and said it doesn't meet the definition because of A, B, C and D. It was a lot of work, but what it meant is they've got this great process in place. Everybody now in the different departments and divisions knows what they're looking for, knows that if they're going to sign an agreement that potentially could be captured, they talk to finance, and they've got this ongoing process now that they go through. You guys have to think about how you are going to make sure your population of leases is complete, because I can guarantee that the auditors will be looking to see what have you done to make sure that you've identified everything. So don't assume that what you currently have with the word lease on the piece of paper is the only leases you've got. I don't care what the piece of paper is called. If it meets this definition, it is a lease. Any comments on that one?
We see lots of arrangements where you've been using a building for the last 37 years and nothing in writing, just always has been.
So it's still, and I might park your question because I will talk about lease term a little bit later on, it's still a lease. So we go, it is still a lease because it's a contract that's an implied contract because we're still there, and then we focus on what is that lease term that we're looking at. One of the other issues that we're seeing is we've identified this contract. But within the contract, certain components of it will be lease components, certain components of it will be non-lease. So let's take a building lease, and let's use this building. We're using however many floors of this building. Let's say we're using 4 floors, and we pay X amount per month. As part of that X amount per month that we pay, we have exclusive use of the 4 floors we're leasing. We have use of the common areas. We have use of the lifts. There isn't a concierge downstairs, but let's pretend there is. Concierge and security services, external cleaning, major maintenance of the building. So of all those things that we pay for, it's only the exclusive use of the 4 floors that are actually the lease component. So what this standard says is of the X dollars a month that you pay, you separate out that X dollars into the amount that you pay for the lease bit, the exclusive use of the 4 floors, and the amount you pay for everything else. The lease part gets recognised as part of your lease liability and your right of use. The rest of it gets recorded through the P&L as and when incurred. Or you choose not to do that. You choose to use the practical expedient that says don't worry about separating it, just lump everything together. So those of you in the room who are all nodding at me, going, well that sounds much easier, that's absolutely what I'm going to do. It is much easier. The downside, however, is your liability is overstated. So depending on how big or small that lease component is, you can end up with quite a big lease liability, where if you separated it, that liability could be much lower. So it's an accounting policy decision that you guys need to make. You make that decision on a class of asset basis. So you can choose to separate for your buildings, you can choose not to separate for your vehicles, for example. If we think about vehicle leases, the vehicle leases would include servicing, they would include maintenance, they would include roadside assistance, potentially they would include petrol. So do you choose to separate out those amounts or not? I said it was an overstatement of a liability. It is an overstatement that's allowed by the standard because it's this practical expedient, but an accounting policy decision that you'll need to make. How do you actually separate the amounts out? I'll share with you a piece of guidance that the New South Wales Treasury put out because it's one of my favourite bits of guidance. So they mandate all of their departments and agencies to separate. And what they've said is if the information about the non-lease component is not included in the lease, then estimate it. Full stop. That's it. And that's effectively the only guidance that we're seeing anywhere. The standard doesn't give us any more guidance. You have to just estimate how much you think is lease and non-lease. Now that can be challenging, that can be judgmental, because I would have no idea how much into everything else, so how much work do you want to do to go out and do that? But certainly something that we need to think about in relation to the lease accounting. And I don't think people have really spent the time thinking that this is a decision that they have to make. So lease term. One of the big challenges around this, and it's mainly buildings, that seems to be the issue that I'm facing, is where we have options. So let's say that we've signed a lease, and that lease is for a 5 + 5 + 5. So potential of a 15-year lease term, but it may only be 5 years. So we have to make a decision on what is our lease term to know how much liability we should be recognising. Because a 5-year lease liability is quite different from a 15-year lease liability, hugely material. When we're looking at the guidance in the standard, it tells us that it's a non-cancelable period, so the first 5 years. And then we look at renewal periods and we make a decision whether it is reasonably certain we are going to take out that option. What does reasonably certain mean? What does reasonably certain mean to you? Which might be very different to what reasonably certain means to the person next to you. I have some clients who say to me, the fact that those options exist, I put it in there for a reason and therefore it's reasonably certain I'm going to take them out. I have others who say, well, the landlord offered them, so I just took it, I don't really know what I'm going to do. There's other times where there might be an incentive. So I had one client whose their lease was a 15-year plus 2 5-year options. So they were trying to decide, is it a 15-year, a 20-year, or 25 lease liability? They read the terms of the lease and it said that if they exercise one of the options, they will not be required to make good the building. To them, it was such a big incentive that they said, well, obviously we're going to take out one of the options at least. So our lease term we're going to assume is 20 years. We don't know about the second option. We don't know what's going to happen in 20 years' time. but at least that's our basis for our lease term. So thinking about that lease term, why were those options put in there? What was the rationale behind it? If you had something like a 2 + 2 + 2, and you tell me that actually you're not going to renew, most leases say you have to give us 9 months notice. I would struggle if you tell me you don't know what you're going to do in 15 months' time. If you haven't started looking for a new building, if you haven't had minutes, etc., that say you're going to move out and put things in play, I'm really going to struggle if you tell me that you're not going beyond that first 2 years. Auditors traditionally are quite nervous about understatement of liabilities. So again, be expected to tell that story. Why have you only put this particular lease term in there? Why have you not included the other lease terms? To explain that liability. Tell the story. It takes time. Finance people, you generally aren't negotiating your leases. So if we think about who is, have the discussion with them. Why did they put those option periods in there? So to come back to your question, Darryl, about what in relation to lease term, if you've got lots of agreements where you haven't got a particular written agreement, what do we do? We look at the time that it is non-cancelable. So if we have nothing, effectively, it can be cancelable at any time. We don't have any enforceable period. It was actually brought to the board meeting in April that there's lots of differing views now in Australia and internationally about holdover periods. So holdover period is where you finished your lease and you're staying there and you're doing the month to month. What's the lease term? Most people seem to be along the view of, because the lessor can cancel it after 30 days, it's not enforceable beyond 30 days, and therefore, although it's a lease, it's only a short-term lease because your lease term is actually effectively a month. Even though you're planning on staying, you actually don't have any control over whether the landlord kicks you out or not. I'm expecting the issue will probably go to the International Interpretations Group. We can't interpret it in Australia because we won't interpret an international standard. So we may see some more guidance around this. There is some information within the basis for conclusions, and rewording it slightly, it says, surely no entity would enter into this position because there's a massive business risk, because you could get kicked out in a month. And that's genuinely the view that the International Board have taken. We have a huge number of entities in Australia who are in holdover, or it might be a related party lease and there's absolutely nothing. A not-for-profit who's occupying a property don't want to go back to their landlord because the landlord might remember that they're there, and therefore that they just keep going with not actually paying any rent. So we are expecting some more guidance, but at this point in time, the most consistent view seems to be you do have a lease, but the lease term is a short period of time because it's not enforceable beyond that 30 days period. Even if you haven't got a lease, it's generally deemed that somebody would have to give you at least 30 days notice to kick you out, as opposed to turning up and saying you're out tomorrow. So lease term, again, something that we need to think about in relation to our leases.
And you're not allowed to rip up a lease?
Not allowed to rip up a lease and say you haven't got it, because it exists somewhere, Darryl. So to a bit more information on that enforceability, this is what is written in the implementation guidance. It's not actually in the standard itself, it's actually buried at the back. Lease is no longer enforceable when both the lessee and the lessor have the right to terminate. So that's the holdover periods that I was talking about. If only the lessee has the right to terminate, and that's generally the case where we have these option periods, it is up to the lessee to decide whether they're going to terminate or whether they're going to exercise. We consider that reasonably certain. If only the lessor has the right to terminate, then effectively we can't control what the lessor is going to do, and therefore we just pull in that non-cancelable period where they can't kick you out. So that enforceability is something that the more you start looking at your leases, the more you realise that actually what position are you putting yourself into? Take off accounting standard hats. Are we happy that the lessor could come and kick us out in 30 days? Because if they were to, where does that lead us? We're not going to be easily find a building to move into in that 30-day period. It's hugely costly. What would we end up paying? And we have seen some entities have, as part of this and part of governance work, have said, you know what, we need a proper lease in place. We need something that gives us a bit more certainty around this. Any more questions or comments on that enforceability? So we've looked at what is a lease, we've looked at the lease term, we've looked at separating it. If we look at now, how can we possibly get out of that leasing? It comes back to that materiality question, and I said there was two exceptions. You still have a lease, but if you meet either of the exceptions, then you can choose not to do lease accounting. The two exceptions relate to short-term leases, which is where we've got a lease term of 12 months or less. So we've looked at what lease term is. If you've got renewal periods, you take that into account. A rolling 11-month lease is not a short-term lease because you keep rolling it. The other one is the leases of low-value assets. So this is one that we're getting a huge amount of interest in. Any of you who have any US reporting, this exception doesn't exist in the US equivalent standards. The standards are pretty identical, but that doesn't exist in the US standard. It means that it's the only time in this standard you look at the value of the asset you are leasing. Nothing to do with the liability, nothing to do with how much you pay, purely due to the value of the asset. And you look at what's the value of the asset as a new asset. So if you try and get out of it by saying, but look, I'm leasing a second-hand photocopier and it's really cheap, it's what's that modern equivalent value as a new asset. Generally, what we're seeing in Australia is the low-value assets have been taken to be round about $7,000 to $10,000. Standard tells us it's expected to cover laptops, tablets, office equipment, furniture, but it will not cover vehicles. And that's where the 10,000s come from. People have said, what's the cheapest new car you can buy in Australia? It's probably around about $10,000. So most people are sticking to roughly $10,000. It's nothing to do with materiality. It is, regardless of the entity, whether you're a small not-for-profit, a medium-sized manufacturing entity, or BHP, your low-value asset threshold will be the same, roughly. Materiality is different. So you could still say, I'm not booking this because it's not material, but that is a different decision from I'm not booking it because it's a low-value asset. So even if we've got one lease, one laptop, obviously we can choose to use this. One lease, 5,000 laptops, because we can benefit individually from each of those assets that we've got, we can still use this threshold. It is genuinely nothing to do with materiality. So as long as we can benefit individually from those assets, we're able to use this exception. It is a choice. Entirely your decision whether you use it. With the short-term leases, you are locked in per class of asset. If you choose to use it once, you have to use it for every other short-term lease in that class of asset. For the low value, you make the decision on a lease-by-lease basis. So they're the two exceptions. So we've got a lease, but we can use the exception so we don't do lease accounting. If we've got a lease, but we don't meet these exceptions, and that's going to be your vehicles, your buildings, and your larger office equipment, probably your photocopiers, we're into the lease accounting. Within this standard, there is a number of scope exemptions that are mandatory. There's also an optional scope exemption, which is very unusual for a standard. It says you can choose to apply this standard to leases of intangible assets. My very strong recommendation is that you do not choose to apply this standard to leases of intangibles. You do not want to be sat there trying to work out whether your Office 365 subscription is a lease or not. Just make the decision that you are not applying this standard to intangibles, unless you've got a very, very good reason, which I have not yet come across. Just creating more work for yourself if you make that choice to include it. So let's assume you are following my recommendation. My right of use asset that I create will therefore be a tangible asset. It follows the treatment of the underlying asset. That right of use asset will be non-current. Exactly the same as property, plant and equipment is always non-current. The lease liability will be split between current and non-current. So we are bringing on an asset, a non-current asset, with a current liability and a non-current liability. Those of you who have bank covenants, the bank care about current ratios and solvency ratios. If you have not already had the discussions with your banks about the ratios in your bank covenants, you might want to have it very, very quickly, because potentially adoption of this standard will cause a breach of a bank covenant, because the current liability is there without being offset with a current asset. I've had a number of entities have said to me, it's okay, we've talked to our business banker and he said it's fine. Did you get anything in writing? No, but they said it was fine. That's great, but the bank agreement that talks about the covenants is in writing and is an enforceable document. So they can choose to call on it if they want to, if you have breached. So make sure that you're looking at that. We'll talk about a number of these issues that sit outside the financial statements that you need to be aware of. So hence our balance sheet will look quite different. We can choose to show this separately on the face of the balance sheet. Certainly that's my preference. I think it's a new type of asset. I think it's potentially quite material. Let's show it as a separate line item. The alternative is you show it as classes of assets within property, plant and equipment, but I think you're better off showing it separately. And I would also pull out lease liability and show that separately on the face of the balance sheet. From an income statement perspective, we no longer have rental expense. What we have is interest that is linked to the lease liability. With any liability, you pay more interest at the start and less interest at the end. So that means that we will have a declining interest expense profile. More interest at the start, less interest at the end. The depreciation is based on the right of use asset. That will be straight line, because what we're depreciating is the right to use something. And we have the same right to use every minute of every day. So therefore, that will be straight line. We have to consider whether our right of use is impaired. It might be impaired because, for example, rents have plummeted. So the value of the asset that we've got has dropped. The lease liability hasn't changed, but the value of the asset has dropped. Therefore, we end up with an impairment. We no longer have onerous lease provisions, it's an impairment. Then we start to see more of the devil of the detail in this particular standard. Because let's say I've got a lease that is variable dependent on sales or usage. We'll use the photocopier example. I pay $200 a month plus 2 cents for every copy that I make. I don't know how many copies I'm going to make. I can't guess how many copies I'm going to make. So the $200 a month gets recognised as my lease liability, my right of use asset. The 2 cents a copy gets recognised as a variable lease expense through the P&L as and when incurred. So for my simple photocopier lease, I have interest, depreciation and variable lease expense going through the P&L. This is not a simple standard and it is not the same as finance lease accounting. So that's from the overall fundamentals, what we're dealing with in this particular standard. If we look at how we calculate the liability, we always do the liability first. We start off with any fixed payments, take off any incentives that are receivable. For example, a rent-free period. We don't pay rent for 6 months, therefore it's not part of our liability. If we've got a residual value guarantee, we add that in. If we've got the variable lease payments which are dependent on a rate or index, that's your CPI, we have to deal with that. We don't guess what CPI is going to be. We assume whatever we pay today is going to be the same payment. So for example, we pay 100 today, and we know that our payments have to increase by CPI every year. On day one, we assume the payments will be 100 for the life of the lease. CPI is 3% next year, and therefore we have to pay 103. We then recalculate, assuming our payments will be 103 for the life of the lease. Next year it changes to 105, we recalculate again going forward, assuming it will be 105 for the life of the lease. This is not a set and forget standard. We have to continue to recalculate. I can pretty much guarantee you've all got more than one lease, and I can pretty much guarantee that they don't all have the same anniversary date. It's not that on the 21st of May, they're all subject to their CPI increase, it will be throughout the year. So how are we going to track that? Yes, materiality still exists, but if you kind of got a number of leases and you're out of whack, it could be a very material difference quite quickly. Lease payments during the optional period, if it's reasonably certain we are going to exercise that option, we include those. If there's a purchase option and it's reasonably certain you are going to exercise that purchase option, we include that as part of our lease liability. If it's not reasonably certain, we don't, but it may become reasonably certain, we then have to adjust. If we've made a note that, let's say my lease term is 5 years, but actually for whatever reason, I think I have to terminate it at 3 years, and that's what I've factored in, is a lease liability for 3 years, but there's a penalty for early termination. If I'm assuming my lease term of 3 years, I have to include the penalty. So I'm doing apples with apples. Whatever I choose to be my lease term, all payments that I will make within that, I include. So that is my calculation of lease liability that I have to do for all of these.
Simple.
Simple, that's right. I then take that lease liability and I put it into the right of use bucket. So this is why I do liability first. Once I've put in my lease liability, I also add back any prepayments that I've made, because I have to gross up my lease liability. If I've paid 3 months in advance, that's not in my lease liability, so to get the true liability at day one, I add that back. I take off lease incentives such as, here you go, I have a $5,000 fit out allowance. Any initial direct costs that I've incurred, for example, stamp duty, legal fees, lessors fees that I keep seeing more commonly in leases as well, they get added back. And then I add back my dismantling, removal and restoration costs. That's my make good provision. We still need the provision. The debit, however, goes to right of use asset. What we're seeing is as entities are actually reading their leases, they're realising the make good clauses are fairly substantial. They've never had a provision in there before. We're seeing more of these provisions happening. So we need to make sure that we're looking at that. That then spits out to be your right of use asset. So that's how the two different components are calculated. Show you a quick example. I've got an equipment lease and with an interest rate that I have made up to be 6%. That interest rate is not to be used, it is completely made up. What the standard tells us is that we use the interest rate implicit in the lease, and that's fantastic if there's one in the lease. Generally there isn't. Finance leases do. I have yet to see a traditional operating lease that has got an interest rate in there. How do we come up with an interest rate if we don't have it in the lease? It tells us that we use our incremental borrowing rate. Again, that's great if we've got variable borrowings because we know what that is. Not so great if we don't have borrowings or all our borrowings are fixed. The RBA do put out indicative lending rates, and that's a good starting point, but you need to add on a risk margin. And what's that risk margin going to be? So some work around the discount rate. In my example, we're just assuming 6%, my made up figure. I've got a 5-year lease. I pay $500 a month, but I've cheated slightly and just done it as one payment of $6,000 every year, because otherwise my spreadsheet would be very, very long and wouldn't fit on the slide. So I've applied the discount factor and I've come up with a discounted liability of $25,274. And that's the liability that I need to record on day one. I then take that liability and I put it in. I look at the other components for my right of use asset, and I know that there's initial direct costs of $525. So my initial right of use asset is $525 higher than my liability. What I then do is for every payment that I make, I use the discount rate and I apportion part of it to interest and part of it to principal. As we've talked about, the interest will be higher at the start and lower at the end. My depreciation is straight line, so I do 5,160 every year, so my total P&L charge is this. Under the old standards, I would have recognised $6,000 a year, straight line basis. So depending on where I am in the lease term, you can see my expense will be either higher or lower than where it was. Now in this very simple example I've done in Excel, there's no options, there's no CPI, there's nothing else complicated because it just creates a monster the more variables you add, and I just wanted to illustrate a very simple example around that. One of the other issues that I'm seeing is subleases. So the issue for subleases, these guys at the top, the head lessor, don't have an issue. These guys down here, the sublessee, don't have an issue because they're only in one model. The problem is these people, because they are in the lessee model and the lessor model. The lessee model is what I just talked through. We've got a right of use asset, we've got a lease liability. The lessor model is you differentiate and determine whether your leases are operating leases or finance leases. If they're an operating lease, we keep the lease on balance sheet and we just recognise the income as received on a straight line basis. If it's a finance lease, we do recognise the asset and we recognise a net investment in the finance lease. So if you are here, you've recognised a right of use asset and a lease liability and a provision for make good, so you don't forget. And then you have to consider, of that right of use asset that I've got left, have I just issued an operating lease or a finance lease? The most of them I'm seeing are finance leases, because what you generally see in relation to a sublease is if I've leased something for 5 years, I'm a year in and I decide I'm then going to sublease the rest of it for the remaining 4 years, and generally it's the same amount that is in that head lease. So it means I've leased it for its full remaining yet useful life to me and for the amount that I'm paying. So it's fair value to me. So that means that we're seeing derecognition of right of use assets, recalculation of what that net investment of a finance lease is, which takes into account costs, which might change the interest rate. It's painful. What's even more painful is that I'm leasing 4 floors of a building and I sublease one of them. Because how much of my right of use asset do I de-recognise? So just bear in mind, I don't have time to talk much more about the subleases, but bear in mind if you are in this position here, it is really not pretty. So please start thinking about this. If you are even thinking about subleasing in the future, make sure that you've got some process in place to work through this. Because the majority of the leases I'm seeing, subleases I'm seeing, have been finance leases, where in the past we just went, the whole thing's an operating lease, let's just ignore the whole thing. Now we can't, because we've got that asset on balance sheet. So how do we actually transition to this particular standard? There are 2 choices in the standard. One choice is hard, the other choice is much easier. Therefore, I'm recommending the much easier option for you. The much easier option is this modified retrospective, where you do not restate comparatives. For the first time ever, the International Board has made it easier to do the wrong thing. The right thing is that we restate and we have beautifully comparable financial statements, but what they've said is if you do that, that's great, but you've got to fully apply AASB 108, which is our change in accounting policy standard. If you choose not to do that, and if you choose not to restate, we're actually going to give you all these practical expedients to make life so much easier. So because they've given us things to make life easier, well, let's go for the easy life. This standard is hard enough as it is. So hence we're seeing most entities applying this modified retrospective approach, which is where we do not restate. The only transition disclosure that you have to do is in relation to your operating lease commitments note. So what we have to do is turn the operating lease commitment note, so I've got both dates depending on whether you're a June or a December. It will take a June year to June to lease liability at 1st of July. All the reconciling items should be known. If we have line items in there that say additional leases recognised under AASB 16, the question is why weren't they recognised in the past? There will be potentially some that didn't meet the old definition. The vast majority of them probably did meet the old definition and you just did it wrong. If we have a line item in there called other, well clearly that's a balancing figure, and what have you done wrong? Why have you not been able to reconcile it? So some of the reconciling items that we will see, we will obviously add back finance lease liabilities because they weren't in our operating lease commitments note. We will have adjustments because of the discount rate. We'll have adjustments because of dealing with CPI. We'll take out short-term leases. We'll take out low-value leases. We'll take out the non-lease components if we choose not to recognise it. So we know there will be known things needed in that reconciliation. It's the unknown, it's the obvious errors we really want to avoid. So make sure that for those of you who have not yet signed off your previous financial statements, that you make sure you've looked at that operating lease commitment note and really given it a lot of attention. Ideally, you do that reconciliation before you sign off the accounts, because then you've got your opening position going forward, you know that you're on the right track. In relation to the practical expedients, there are a significant number of them. You can choose whether to use them or not. Generally, I'm not a great fan. I generally would say, no, if you're going to do something, just do everything right. However, these make your life so much easier that hand on heart, I'm telling you to use them if you possibly can. When you review the standard and you look at the transition section, there is a comment in there that says you are not required to reassess whether an agreement contains a lease. And you'll say, Cameron spent all this time telling us that we had to look at all of our agreements and working out whether they contained a lease. What there should be is an extra sentence there, where you looked at these agreements previously under the old standards. If you did not look at the agreements under the old standards, if you never even considered whether they contained a lease, it's not an excuse to carry on bad accounting. So we as standard setters assume in our little ivory towers that everybody is complying fully with the standards. So we can't write assuming you did it properly in the past, because we have to assume everyone did it properly in the past. So just be careful when you read that. Don't get really excited. If you did not look at your agreements, your IT outsourcing agreements, your maintenance agreements, and think about whether they contained a lease, we have to now look at it. Any lease you've got that ends within 12 months of transition, so for a June year end that is ending before the 30th of June 2020, you can choose not to restate. You can just treat it effectively like a short-term lease and just put the expense through the P&L. For your initial recognition, you have to calculate liability properly, but you can choose to just set your right of use asset to be equal to your liability. You don't have to do right of use properly. You can just make them equal, apart from any accrual or prepayment that you've got that you'd adjust for. So it means you only calculate one side of the equation. Again, makes life easier for you. You can choose to use the same discount rate across similar leases on transition. Rather than trying to work out a different discount rate for every lease, you could just say this is the rate that we're going to use for our building leases where it's greater than 5 years, this is what we're using for leases less than 5 years. If you happen to have an onerous lease provision, you can take that onerous lease provision and you can say that's my impairment testing, and you debit the provision, you credit your right of use asset. You're not required to do any further impairment test on transition. If you choose to calculate right of use properly, and my recommendation is don't set it to be the same as your lease liability, but if you do choose to do it properly, then you can choose to ignore initial direct costs. So you don't have to say that lease we signed 10 years ago, what were the legal fees we paid? You can choose just to ignore that. If you do set right of use to be equal to your liability, that's not relevant. For finance leases, this is not the same as finance lease accounting. However, you are not required to recalculate any balances for finance leases at day one. All you do is you reclassify the amounts. So in your fixed asset register, you would have, for example, motor vehicle leased. You would credit motor vehicle leased, and you would debit right of use motor vehicle. So you just take exactly the same figures out, reclassify them in the right spot, and then going forward, that's your AASB 16 opening balances. And finally, we're allowed to use the benefit of hindsight. So we've signed our 5 + 5 + 5 lease, and we're 3 years through the first term. We don't have to say at the 1st of July 19, what did we think we were going to do when we signed? We say at 1st of July 19, we've got 2 years left on this first term, what are we now going to do? So we're able to actually put ourselves at today, which makes a lot more sense. So there's the expedients very quickly. As I say, you will go through and decide which you want to use. They've been put in there to make your life easier. So if you're not going to use them, think very carefully about why you're not going to use them, because they do make life simpler for you.
Is that all or nothing? Sorry,
no, you can pick and choose.
With the full retrospective?
Yeah.
You can't use these?
With the full retrospective, the only one that is applicable is this one up here. The rest of them you can't use. Yeah. So if you still aren't convinced about how much work there is in this particular standard, some more big picture issues for you to think about. I have covered a few of them. Potential changes to contracts and changes to agreements. So if we're actually in the process of negotiating leases today, do we understand what they're saying? Do we understand what that means? Talked about return reporting threshold. For those of you in the room who are listed, once you've worked out the impact of this standard, and for many of you probably should have done already, if it is material, do we need to announce it to the market? We should have seen much more announcements to the market about these standards than we have seen. It worries me that we haven't, because we are seeing big impacts that are coming through. Potentially you are going to open yourself up to class orders. Class actions even, not class orders, class actions, when you publish at the end of the year, at the half year, if shareholders haven't been told there is a material impact on your financial statements, they're going to go, well, we bought shares and we didn't realise what the impact on this entity was going to be. It's just something to think about. Dividends. If you are declaring dividends, you should be declaring them based on your numbers, based on accounting standards. If you have not applied these standards, both the revenue and revenue and leasing standard, you could actually be in breach of the Corporations Act, because you might find that your ratios aren't matching and what they should be to pay out a dividend. In relation to your IT systems, how are you going to capture this information? How are you going to track changes to leases? How are you going to monitor modifications, completeness, etc.? I talked earlier about management accounts and budgets. I talked earlier about bank covenants. Bonuses. One of the reasons that we need to really think carefully about bonuses is because EBIT and EBITDA are about to go through the roof when you adopt this standard, because you are pulling out your rental expense and showing it as interest and depreciation. It will then become the new norm, but it's in that first year. Many bonus schemes are structured that say if you manage to get us an increase of 10%, 5%, 2%, pick a number, an increase in EBITDA, we will give you a big bonus. EBIT and EBITDA are going to increase dramatically. Employees will love it because they will potentially get a huge bonus. Entities don't love it quite so much because it's nothing the employees have done, it's purely due to a change in accounting standard. If you do not get those bonus agreements changed, then you are potentially opening yourself up when the employee produces the document and says, this is what this says, look at the results, they have changed. Similar issue for earn-out clauses. Don't assume that solicitors understand these standards. And if you have got any business acquisition in the last few years that have an earn-out clause in them, the earn-out clause will say, we'll pay you $3 million today, but if EBIT or EBITDA increases by X% over the next X number of years, we will give you an additional $1 million. EBIT and EBITDA will increase by that X%, and again, nothing to do with the performance of the business. So I'm expecting another raft of legal cases where the former orders say, your results are now this, you need to pay us extra money because that's what the agreement says. So we need to be looking at any of those acquisitions that we're currently going through or that we have been through where that time frame is going to overlap with this particular standard. Finally, non-finance staff. There needs to be some education. I know nobody in your organisation cares about accounting standards except you guys who very passionately care about accounting standards. But we have to actually have that communication because this is much bigger than just a finance team issue. We need to be talking to the people who are negotiating these leases. We need to be talking to people about revenue. We need to actually understand this. You need to look at your delegations and say who can actually sign these leases. Because it didn't matter necessarily about signing of an operating lease because there was no impact on the balance sheet. There now is. So we need to be thinking about that. Any more questions on that before I hand over to Michelle? Yep. Correct, so you'll now show your rent as part of depreciation and interest. So depreciation will go up quite dramatically, yeah. Yeah.
Oh, I don't like microphones. There we go. Morning, we all still awake. Thank you, Carmen. You make it sound really easy. All right, let's talk about two other standards, which have really been front of mind for the last couple of years, I'm sure. These standards have been live for almost 18 months now. So they became effective last year, January. So those listeds in the room, you would have had maybe one reporting period, at least one, maybe two reporting periods under the new standard. Non-listeds in the room, with 30 June fast approaching, hopefully you've got to grips with these new standards and you're understanding what these standards entail and how they're going to impact your business. Either way, we just thought we'd spend a couple of 20 minutes or so just going through things or recurring issues when it comes to these two standards. Kicking off with AASB 9, specifically classification and measurement, which was one of the big changes under the new standard. Can you all hear me if I don't use the mic? Okay, just let me know if you can't. I like to walk around. These were the old categories. They have changed. There's no more held to maturity. Available for sale has also disappeared, and I certainly know from some of the clients that I've been dealing with, available for sale was a common category. these two no longer exist. There's now new principles that you need to apply in, you've basically got to jump hoops to get into the amortized cost or fair value through OCI categories, that being the cash flow characteristics test, and depending on the entity's model or the way that they manage their portfolios of financial assets, that determines whether it's amortized cost or fair value through OCI. If you don't jump those hoops, you'll land up in the residual category, which is now fair value through P&L. That's substantially different from the old standard, where the residual category, if you didn't make those three, it was available for sale. Changes here went through other comprehensive income, not the income statement, whereas the residual category now, those changes in fair value go through the income statement. So that's, in a nutshell, the classification criteria. What I want to just chat about, as a reminder, there was a limited cost exemption in the old standard for those investments in unquoted equity investments, so unlisted shares. What did everyone do? They carried them at cost because it was fair value, couldn't be measured reliably. That cost exemption no longer exists. Just make sure if you've got these investments in unlisted shares, you cannot carry them at cost anymore under the new standard. You'll have to measure those at fair value using AASB 13. So just something to be aware of. The other issue that I've seen quite frequently is the assumption that, oh yeah, I had available for sale financial assets under the old standard. They automatically qualify for fair value through OCI designation. That is not the case. So let's just have a quick chat about it. Generally speaking, equity investments are generally classified at fair value through P&L. And that's because they fail the solely payments of principal and interest test. So listed shares, for example, is the easiest example. There's one exception to this rule, where if you've got equity investments, you can make a one-off irrevocable election to classify those or certain qualifying equity investments at fair value through OCI. Why is this appealing? Because we want to remove the volatility linked to the changes in fair value. We don't want that going through our income statement, so we prefer to put it in OCI, which is what available for sale did. Now, I think it's important for entities to understand the implications of making this one-off irrevocable election. That meaning, once it's done, you cannot undo it. The implications are that, as I've said, subsequent changes in fair value won't go through the income statement, they go through other comprehensive income. Those cumulative changes in fair value that accumulate in equity can never ever be recycled through P&L. And that is a difference between these two categories. Fair value through OCI for debt instruments, for example, vanilla loans, loan receivables, investments in government bonds, for example, those cumulative gains and losses that accumulate in equity, they can get recycled through P&L. That is not the case for this designation. Even when you dispose of the investment, it would not go through income statement. All you would do is just basically transfer that reserve to retained earnings within equity. Some clients don't always understand that, so I just think it's important that I tell you that. Because nothing's going through P&L, there's no need to review these investments for impairment, which is a bonus. And dividends continue to be treated as normal going through P&L, as when you receive them. This election is not done at a portfolio basis, it's done on an instrument-by-instrument basis. Not all equity investments qualify for this designation. And that's where I say be careful to just make your previously classified available for sale instruments now fair value through OCI equity. These equity investments must be non-derivative and they cannot be held for trading. And then secondly, This is quite a technical point, but I'm going to try my best to explain it. To be eligible for this fair value through OCI classification, it must meet the strict definition of equity from the perspective of the issuer. What that means, I'm going to give you an example of the best way to explain it. If I am, think about investments in a unit trust, which a lot of our clients have. I'm the issuer of those units, you are all the unit holders. At any point in time, you can put those units back to me, and I will have to give you the cash for those units. So as the issuer, technically speaking, if I have a contractual obligation to pay you cash, how can it be equity? It's a financial liability. But because of an exception to the general definitions of liabilities and equity, I, as the issuer of those units, get to classify those units as equity, not liability. Which means you, as the holder of those units, that financial asset sitting on your books, doesn't qualify for fair value through OCI designation. My message, understand your portfolio of investments, understand the nature of those investments, and don't assume, oh, they were available for sale, they automatically qualify for fair value through OCI. Not necessarily. Investments in open-ended mutual funds, investments in unit trusts, limited life entities, partnerships, those kind of things, they might very well be fair value through P&L. I'm seeing this quite commonly. Any questions? Yes?
You don't have to notify unit holders, or just notify them with no changes to contractual agreements.
Sorry, just say again.
No changes to contractual agreements with the unit holders.
No.
Once you made that election.
No.
Michelle, if you've got an investment in a fund, and you have units in a fund, and the unit price is published every Friday, and on dissolution of the fund is just split amongst the unit holders.
Yeah, and you'll get...
Let's say that fund only invests in debt securities. But me as an investor, do I have an equity investment or a debt investment?
I'm not sure, Daryl. You'd have to look at the underlying, the nature of those investments.
Yep.
At the end of the day, the issuer of those units, if they are contractually obliged to make some kind of cash payment for whatever reason on dissolution, like limited life entities, they're probably classifying the units as equity because of the exception. So it very may well be that you would not have the fair value through OCI option available to you. But the challenge with this is, as holders, how do you know? And that question has come up to me. I don't know, without going to speak to the fund. It's a challenge. I don't think everyone's getting it right. Yeah, I don't have that answer, unfortunately. Just some other challenges with AASB 9, related company loans. A reminder that AASB 9 does not distinguish between unrelated third-party loans and related company loans. So the provisions in terms of classification, measurement, and the new ECL or expected credit loss model apply to related company loans. Now, I know some of you are looking at me like, it's a moot point, Michelle, because on consolidation, everything gets eliminated. I'm talking about the perspective from the parent entity. If you think about the consolidated financial statements, there's a note in the financial statements called parent entity information. Those balances on the balance sheet, which include intercompany receivables, is included in that note. You'll have to make sure that they have been correctly treated under AASB 9 in terms of classification, measurement, and impairments. Just something else to note, AASB 9 gives very specific guidance on the treatment of long-term interest-free loans. So, technically speaking, those should be measured at the present value of your future cash receipts using an appropriate market rate of interest. And this is not a new issue, it's just that AASB 9 is now quite explicit about how these loans should be treated. Something that I'm also not seeing is done correctly all the time, just letting you know. So this is again, parent entity separate financial statements.
Question for you on that one. If it's a related party loan, they often don't have a term.
Management's best estimate, cash flow projections. It sounds so much easier when you're reading the literature out there and the examples. It's always management's best estimate. We think we're going to have the funds available to pay in 3 years' time, so therefore we'll present value it for 3 years.
Could it be that there's no present value on these because you just can't estimate?
I think how a lot of people are getting out of this is just saying payable on demand, short term. So, expected credit loss model. Just a reminder, the new impairment provisions don't just apply to trade receivables. It applies also to related company loans, key management loans, loans with personnel, any of the debt instruments at fair value through OCI, contract assets arising under the new revenue standard, as well as any lease liabilities under the old or AASB 117. So it applies to just a lot more than just trade receivables. Bear that in mind. Challenges arising, the way we used to do provisions or under the old standard was really looking back in the past. Your models will now have to include forward-looking information. So for example, your impairment provisions for debtors often are based on historical default rates. So that's still fine as a starting point. At reporting period, you will have to adjust those historical default rates to take into account current conditions as well as future economic conditions. And that's going to involve looking into your crystal ball, estimation, judgments. So document these considerations, document your judgments, because the auditors will ask for them. So this is one of the biggest changes for impairment provisions. And then just a reminder, simplified versus general approach. If you have short-term trade debtors and contract assets, in other words, they don't have a significant finance component, you have to use the simplified method, which, as I said, is simple. You don't have to track changes in credit risk. It's much easier than the general approach. However, if you have trade receivables or contract assets that are financing components or lease liabilities arising under AASB 117, you have an accounting policy choice. You can either apply simplified or the general. Okay. Moving on to AASB 15, we'll just spend some time talking about things that we're seeing out there. Still very common is the new standard has got no impact on me and my business. Well, I would say that's great if you've done a detailed impact assessment and come to this conclusion. If you haven't come to this conclusion after doing an impact assessment, I would say, how do you know? Without working through the new 5-step revenue recognition model and applying the very detailed guidance, how would you know? As a minimum, if you come to the conclusion that there is no significant impact in terms of timing and or amount of revenue recognition, what about disclosures? The listers in the room that have gone through half year, you would have had to deal with transition disclosures. Year-end full disclosures is an entirely different beast. There are a number of new disclosures under the new standard. So A, you'd have to understand what those disclosures are, and B, what systems am I going to have to put in place to extract the information so that I can meet the disclosure objective of AASB 15. It's no simple task. You'll also have additional things like you now have to disclose disaggregated revenue. You'll have to think as an entity, What basis is appropriate for me to disaggregate my revenue? And again, how am I going to get that information out of the system? And that disaggregated revenue is both a half-year requirement as well as an ongoing full-year disclosure requirement. Don't forget, if you are going modified approach, there is, because of lack of comparability in your financial statements, there's an additional disclosure that you'll have to make. You will have to present revenue numbers under the old revenue standards as well as the new revenue standards. And that's a challenge because you basically have to run parallel systems to come up with the two numbers if the standard significantly impacts you. And then lastly on disclosures, don't forget about your accounting policies. They have to be updated. I'm still seeing accounting policies referring to the transfer of risks and rewards. Irrelevant now under the new standard. You will need to update your accounting policies to explain revenue to users using the concepts and the terminologies under the new standard. I think that's a challenge for us as accountants because we're not good at using words and explaining, we're good at the numbers. And good generic boilerplate type disclosures under the new standard are gone. You'll have to make it specific to your entity and explain performance obligations, how you identify them, when do you know you've satisfied them, etc. No easy task. One of the biggest learnings in my last 7 months being with HLB Manjud is that step 2 of the revenue recognition model is proving to be the most challenging, the identification of performance obligations. It's a critical assessment because performance obligation is actually the unit of account now for revenue in terms of timing and amount. So you have to get this right. Basically step 4 and step 5 hinges on step 2. You get step 2 wrong, revenue recognition could be wrong. The problem with this is that the concept of performance obligation is completely new to us. And it involves a lot of judgment. And also, whenever have we had to put ourselves in the customer's shoes and ask ourselves, is the customer getting any kind of benefit from me transferring this good or the service? At the end of the day, if the customer is not benefiting from whatever I'm transferring, there is no performance obligation. So be careful with things like implementation fees, mobilization fees, setup fees, initiation fees, processing fees. Generally speaking, as you're doing those activities, the customer's not benefiting. So the revenue generally has to be deferred. Contract liability, and you'll raise it over, and you'll recognize the revenue over the period which revenue is recognized, which could be contract period, or it could be expected life of the customer, which brings me to my next block. If there are renewals in a contract, you will have to take those into account. Perhaps the expected life of the customer will be longer than the contract life, it will depend on the terms of that contract. So just something to think about. What is the appropriate period over which to recognize things like upfront fees? Don't forget about related costs. The standard is now very specific about how to treat costs to fulfill or costs to obtain a contract. If you meet the criteria, they have to be capitalized. There's a practical expedient. If the amortization period is less than 12 months, you can expense them. Otherwise, you have to capitalize them if they meet the criteria. And then you amortize it again over the period that the revenue is recognized. Okay, so that's going to change your balance sheet. That's going to bring on new assets that weren't there before, or maybe they were. Just something to think about. And again, don't forget about the related accounting policies. If you're bringing significant assets onto the balance sheet under the new standard, you need a supporting accounting policy for that. And good old principal versus agent. As soon as there's another party involved in delivering goods or services to the customer, you will need to make an assessment if you're acting as principal or agent. Principal, you will be primarily responsible for delivering those goods or services. Agent, you're arranging for another party to deliver those goods or services. So you need to think about this, and this is crucial because it impacts how you recognize revenue. Is it on a gross basis? So revenue less cost of sales as a principal, or if you're the agent, you should only be recognizing the commission. So no impact on net profit, but certainly an impact on revenue and cost of sales, which could impact key performance, key KPIs, or reporting thresholds, potentially. So just something to think about. Don't think we've always been too good at it in the past. So don't forget about that. Colin, I'm going to hand over to you for the additional things you've seen.
So just a couple of comments on the last point. I guess when I've been working with a lot of corporates, they will often hand me a contract and they'll say, we've looked at this contract and this is our answer. And it might be the answer on that contract, but what other contracts have you got in place? Because most entities will proudly tell me that they tailor their contracts for every one of their individual customers. And that's lovely, but not under this standard. Because as soon as you start varying terms and conditions, it means that your potential revenue recognition policies will change. So many decisions under this standard will often hang on a particular clause in a contract. So when you are doing your analysis, make sure that you appreciate that every contract you've got will be different. What I've seen happen in a lot of entities is the finance team have said these 10 clauses cannot be changed. Salespeople, tailor it to your heart's content, but do not change these 10 clauses. If you want to change them, you need approval from finance, just so you've got an understanding of that. The other one is in relation to an open contract. So what I'm finding is people are saying, okay, we need to work through this, so we'll go to transition date, let's say 1st of July 18. What contracts are we currently working on? And that's what we need to restate. What we forget is, let's say we offer a 10-year warranty on a particular product. Any item we have sold in the last 10 years, there is still a promise that is open to the customer, still a performance obligation. So we sold an item 6 years ago, you probably recognised all of that revenue under the old standards. Under the new standard, there's 4 years worth of promises that you still have to give to your customer, 4 years worth of performance obligation. So you need to work out how much of that initial transaction price was relating to the 10-year warranty, and at transition day, we reverse the 4 years that are still yet to be recognised and re-recognise it through the accounts. So when we're thinking about what is an open contract, it's not just what are we currently working on, it's every contract where there is still an outstanding performance obligation, still an outstanding promise to the customer. And those long-term warranties are things that are really catching people out because they just have gone, the sales happened, you know, the people haven't approached us because luckily nothing's gone wrong, but the promise, the performance obligation, the benefit the customers still have is that they can still come back to you within that particular warranty period. So again, it's that completeness, making sure that you have restated all of those right balances.
I was lucky enough to have Carmen presenting previously on a little bit to do with the leasing and revenue recognition standards. And so for those of you who weren't lucky enough to enjoy my presentation that morning, one of the things that I thought would be useful to bring up was after that presentation, I then said to all the people who were there, so everything that Carmen's just said about how it gets treated for financial reporting purposes is all completely different for tax. And then I thought, well, that's not entirely helpful, so I suppose it'd be useful for everyone who's here understand certainly the interaction that I have as a tax professional with financial reporting tends to be around tax effect accounting. So what I do see, for example, running back through Michelle's presentation here, there's this sort of a sorcerer's apprentice effect happening here of expanding balance sheets where I can see assets and liabilities coming into existence where previously we've not had any kind of recognition of that, certainly for tax purposes. So when I'm sort of going through that process of thinking about how it is tax effect reporting changes and what kind of impacts are you going to have as you implement these new standards, we've got these new assets and liabilities appearing to recognise revenue, or as Carmen's gone through in quite a lot of detail this morning, to recognise things which are characterised by the lease. But now, in some parts of the world, tax effect accounting, I imagine, must be a wonderfully simple thing. So places like Germany, they tend to sort of take their financial reporting standards and then say, well, that essentially is our starting point for most, if not all, tax purposes. But either for whatever reasons best known only to them, we have in Australia a system under which tax reporting is essentially completely removed from all that. So when we see financial standards change, not only can't we assume that the tax features that attach to things like the recognition of leases and the recognition of revenue will change, you can almost assume that nothing has changed. And so what I thought would be really useful as a take-out today is, because what I see as a result of this is that tax effect accounting is going to expand in importance because the financial reporting standards are doing one thing, which is the growth of these new assets and liabilities. But tax essentially remains unchanged, and those tax balances, which basically drive whatever your tax effect accounting is, to the extent they don't change, you're going to have a difference, and finance teams will face this ongoing challenge of having more complex tax effect accounting, more complex understanding of what the tax balances are that drive your tax effect accounting. So I thought it would be useful to run through a couple of situations where, just to describe exactly how tax sees things like revenue, or tax sees things like the use of an asset under a lease or a hire purchase or chattel mortgage. And just to contrast them a little bit with all of the things that you're thinking about and have to be aware of to get your financial reporting correct. So for the aspect that Michelle ran through this morning, the recognition of revenues. So you can sort of see a really stark contrast here. The performance obligations, or what the customer sees, which seems to drive some of the financial reporting aspects, is almost completely at odds with the way tax sees it. If I could summarise the way that tax will recognise revenue and treat you as assessable on amounts that look like revenue, essentially, if you have a recoverable debt, which is due, unless there's a contingency in some case of some type of repayment, essentially that amount becomes recognised and taxable up front. So what does that mean? Well, it means for tax purposes, you're essentially going to be assessed up front, and you might find that for financial reporting purposes, you're taking that income and spreading it out either over the life of the contract, or in some cases over the life of the customer contract, the customer relationship. So what I see from that is, you've got a combination of current tax liabilities going up and deferred tax assets potentially also being increased. Is that important? Well, it can run into things like, if you have to think about thin cap, and I'll get to thin cap, often you're taking into account your current liability for tax, but you're disregarding your deferred tax assets. So that can actually have quite a big impact in your practical debt. Now, another big area is the way in which leases are characterised for tax purposes. So maybe this is the one thing I've got in common with what Carmen said this morning. You can't just look at your leasing folder or the description on the top that says lease. That might be the only thing that I can say that tax does something similar to the financial reporting treatment. So for tax purposes, I suppose what I see from Carmen's presentation this morning is that there's an expansive definition of what is a lease and what gets treated as subject to the leasing standard. Now, for tax purposes, the policy intent has always been, I suppose, to be reticent about calling things leases. In a lot of cases, the tax office guidance will suggest that you can characterise it as a lease, but we're quite reluctant to give you lease treatment. Why? Because for tax purposes, generally speaking, a lease is something for which you claim the entire deduction for whatever the lease payment is. So what I thought would be useful this morning is to describe exactly how the tax position is in relation to lease. So certainly when we're looking at, for example, depreciating assets that under a lease, a hire purchase, or a chattel mortgage, or whatever it is, the really important thing is to understand for tax purposes who is the holder of the asset. Now, for a depreciating asset, there's two central concepts that are relevant here to understand who actually gets the depreciation charge and interest charges as against that person, as against the situation in which, for tax purposes, you claim a deduction for all of your lease payments or whatever the payments are. First one is the idea of the legal owner. That is the person who has the legal rights to the goods. But it also postulates this other idea of an economic owner. And what essentially depreciation rules for tax purposes say is the holder of the asset, that is the person who's entitled to capitalise and claim depreciation on an asset. The legal owner is the person who's entitled to claim that depreciation unless there's also an economic owner. If there's an economic owner, then it's the economic owner who gets to claim the depreciation and the interest charges associated with that. So what's this idea of economic owner? So an economic owner for tax purposes is a person who might not, by definition, is not the legal owner, but they have a right to purchase the asset at the end of it, and it's likely that they will actually exercise that right. Or alternatively, that they can terminate the arrangement under which they hold the asset and benefit from whatever the proceeds are. So that could be a sale option over which essentially it's very likely that it'll be disposed of and you'll get the proceeds from the asset. And I suppose what I see from that is, so there are a range of different circumstances here where leases which will be in place for financial reporting purposes will be ones where you're not going to get that lease treatment for tax. You're not going to treat those assets as being an asset that you hold for tax purposes. Another thing that will flow out of that is, so we get the situation of a mismatch. Financial reporting can call it something an asset, but for tax purposes that asset doesn't exist. It's under a lease. We just pay it out every month. We claim a deduction for our lease payments. It's not even as simple as just a balance sheet approach there, because to the extent that for financial reporting purposes you're doing things such as having notional interest charges on impairment or notional interest charges which relate to a lease, that interest of course doesn't exist, just like the depreciation doesn't exist for tax purposes. So it can get quite complicated in a financial reporting context, because the financial reporting consequence of a lease arrangement can be quite removed for what taxes do. There's a whole range of depreciation and interest charges which from a tax perspective simply don't exist, probably are what, I'm not sure if I'm allowed to call anything a permanent difference anymore, but it would look a little bit like the timing difference. So what can you do as a sort of a practical guidance thing? So the idea of an economic owner, that's a little bit flexible. It's a bit hard for finance teams to work through and to understand, well, so I'll give you an example of one that I came across, which is one where a business has a whole bunch of cars that they hold over a relatively short-term lease. So originally, I suppose their perspective had been, well, we should appropriately just take into account whatever the lease payments are and claim as a deduction for that. But digging into the way in which they actually conducted the situation, it was universal that after each lease term they would pay out the balloon and actually buy the asset and then sell it. So for tax purposes, although it was described as a lease, in an economic sense you could actually see that all of those assets actually should work correctly on balance sheet for tax purposes, because they were enjoying the economic benefit of the asset. It was very likely, and in fact they did always acquire that asset and or sell it and keep the proceeds as a termination of the lease. But so for tax purposes, that asset is correctly on balance sheet. But in a lot of cases, there's some subjectivity which can come in here, and this is actually extracted from a ruling which has been around since 1960, which is longer than me and longer than the life of most tax legislation, certainly. And I suppose what I like about this is, and this is for the training spotters and in the tax world, from IT 28, and what it does is it says, because the tax office had a concern around allowing certain items to be treated as leases, where in fact the final balloon indicated that it was very likely that the lessee was actually going to take possession and come into ownership of the asset. They said, provided the final residual on any of these purported lease arrangements is the same as or greater than each one of those percentages there, we won't attack it as not being an actual lease transaction. So why have this up? I suppose in some circumstances you can get a bit of a bright line rule. You're looking at something that's just described as a lease. You want to actually test whether or not the balloon is sufficient that for tax purposes you can claim your lease payments, and you shouldn't be putting it as something which is a capital asset for tax purposes and claiming depreciation and interest charges. And this is a relatively easy way of going about doing that. So you can actually look at your arrangement, work out what your residual is after each one of those years, and work backwards to a situation where you can confirm that that is or isn't going to be treated as a lease from the tax officer's perspective. The last thing that I want to talk about with you this morning was just a few areas around thin cap. Now, for 90% of my clients, thin cap is something you never need to do, never need to think about, which is fantastic. But for the other 10%, it's intense and a constant concern, and is something that they spend a lot of time thinking about. So if you are in one of those capital-intensive industries and also have some international exposure, thin cap is frequently something that finance teams have to spend a lot of time thinking about. And we will see from time to time, because thin cap and its calculation, how much debt can you bear, financial reporting will come into that sooner or later, because as your balance sheets expand, thin cap and its measurement become more important. Now, the thin cap rules have actually been getting considerably less favourable over time. We started off with a reduction in the safe harbour rate, which is the level of gearing which is permitted for your balance sheet, which went down from the original 3 to 1, which it had been since 2001, now down to 1.5 to 1. And that was, I suppose, not fatal, because as a lot of you will be aware, there's 3 different methods under which you can calculate the maximum allowable debt that you can have for your Australian operations. So a lot of them would start looking to the other alternative methods, which is the worldwide gearing test, where you compare your structure domestically with what it is on a worldwide basis. Or alternatively, for the very brave, you can go through a hypothetical exercise of determining what an arm's length lender would lend to you, and also what would be an appropriate level of debt for you to maintain under an arm's length lending arrangement. But that's very difficult, because the documentation attached to that has to be done before you lodge the tax return, and is quite extensive. It's effectively a transfer pricing exercise, which means lots of consultant involvement, lots of resource usage, quite expensive. So oftentimes, my observation is that clients would be quite reluctant to use arm's length of debt unless they really had to and could get through on either of the other 2 tests. But another thing to watch out for here is that, as originally enacted, the thin cap rules allowed one highly concessional aspect, which was that for thin cap purposes, as we know, we have to just look at our assets and our liabilities and our debt, taking it off the financial statements. But since 2001, there's also been the possibility of recognising, for thin cap purposes only, a revaluation of assets which are not otherwise recognised under financial reporting standards. And you would tend to think that it makes no difference whether or not you've recently done a transaction under which you've recognised intangibles, or those intangibles have in fact been internally generated. Should that make a difference in how much debt your business can bear? Well, I would say from a policy perspective, probably it should, and that was the reason under which certain taxpayers would have a look at their balance sheet and then consider carefully what intangibles could be recognised just for thin cap purposes. Why would you do that? So that your assets come up, and therefore, when you want to come back to, say, the safe harbour debt test, that you're in a position where you could potentially pass whatever that safe harbour debt amount was. Now, in the 2018 budget, and this is where I suppose events over the weekend always make life a little bit interesting as a tax advisor. So the proposal in that budget was that essentially the line that came out of that budget was, what we've noticed is there's been $122 billion worth of additional recognition of thin cap only assets since we changed the level of safe harbour debt, which was permitted for thin cap debt testing, since we changed the rules. So therefore what we're going to do is we're going to take away that opportunity to revalue assets for thin cap purposes only. Now, so where that is up to at the moment is that that's scheduled to start from 1st of July 2019, but is unenacted. And again, like all of these things, we're waiting to see whether or not it gets reintroduced with the new parliamentary term. So this leaves a lot of clients in a situation where they sort of think that these changes, which will take away that opportunity to value, with a couple of different alternatives. What it doesn't do is to say that you can't revalue under the accounting standards, but revaluing under the accounting standards to recognise internally generated goodwill or other intangibles, I don't know how you do it. As far as I can tell, it's usually very onerous, and Daryl says no.
Can't do it.
That's it, Daryl said no. So what else can you do? And I suppose the thing to look at here is that we don't know if these changes will come into being, but a lot of clients are showing a bit more interest, certainly if they are foreign controlled, in having a look at the worldwide gearing tests, because they take you out of that situation where you need to have go through transfer pricing exercise to work out how much debt could your interest bear. They take the uncertainty away around about whether or not you can do a revaluation for thin cap purposes. And in certain circumstances, provided your level of gearing is comparable with your worldwide group, will usually give you a thin cap outcome which is similar, or should give you a situation which you already had. Or for certain outbound investors, if you're heavily Australian focused, and the idea behind the worldwide gearing test is essentially compare your capital structure and your debt levels in Australia with your worldwide levels. If you're essentially an Australian dominated group, you might find that the worldwide gearing test actually does your domestic capital structure looks a great deal like your worldwide capital structure. Therefore, if you're not inappropriately loading up your debt to the domestic environment, the worldwide gearing test really may give you an outcome where you don't have to do arm's length debt test, but you can also maintain the existing levels of debt that you might have accumulated over time. You really don't have the opportunity to deleverage. And that was all from me, but so I might hand it back over to Daryl.
Yeah, with Joel and Michelle here, we're talking about tax and accounting being different, and we just thought we'd have a look at an example we've had with one of our clients on revenue and how it worked. Now, just want you to have a look at this. Now, this is a client of ours who shall remain nameless, obviously, and they operate computer software and rent it out to people effectively. In this particular contract, which is only one of the contracts that they have like this, they've got 27 other contracts that are all different. This one, they're running a loyalty program for a very, very large organisation where, you know, loyalty programs, if you subscribe to my whatever it is, you'll get some points every month, and those points you can go shopping with, like your Qantas frequent flyer points, or whatever airline you choose. Now, so this client says to the big company, we'll run that program for you, we'll manage it, and people can use our website to see what they can buy and all that sort of thing. So they sign up a 5-year contract. They signed it in October 2018. We're talking about a December year end. Now in the contract, there are 4 payments that they get. One on project initiation and scoping, and they got that payment in November. 1.4 million cash in the bank. And then they're working through December into January on the data migration, getting the data into the system so it can operate. And then they had to do development and testing, and then it was, let's get going. So the question was, let's run through the revenue standard for these 4 things. Now, you've all got a copy of our 5-step revenue recognition model, I hope, if you're HLB clients. So we sat down with our client and the finance team to talk about these things. And the finance team are, with great respect, finance people, not operational people. And I'm sure this is commonly the case. They weren't sure of some of these answers to the questions we were asking about what are your performance obligations. So we've got the operations people in, the people who are actually down and dirty, doing the programming, talking to the customers, that sort of thing. And the data migration was a big part. We said, what does that involve? Well, we get paid 1.2 million to take their existing loyalty program, the points that Daryl Swindells and everybody else have got, and putting them onto the new system. And loading up all your goods you can buy through the system and putting them on there. And we'll finish that in another couple of weeks, and they'll pay us the 1.2. Question was, when do we recognise the 1.2? Now, we started talking to the operations people, and they said, tell us about this data migration. Like, one of the tests is there a benefit you provide to the customer? And the answer from the finance team might have been something like, well, yeah, they've got a great benefit because the data is on the system now and it's ready to go. But the question is, can the customer use that? Their answer is, well, no, they can't until the system's up and live. We said, well, what happens at the end of the 5-year contract? Can the customer take that data out of your system, take your system that's already loaded up and use it with another service provider? And the answer to that was, heck no, they can't. This is our proprietary platform. No one else has got this platform. If they get another service provider, they'll have to have their own platform, and they'll have to get the data loaded onto that. We can give them the data, but the data is just the data. It's not all the migration getting onto the system. So we came to the view that data migration was a performance obligation that was needed just to get the thing moving. It wasn't a separate performance obligation. And we came to the same view over the development and testing and the implementation and go live. So we came to the view that there was only one performance obligation here, and that was to run this program for 5 years. And therefore we said to the client, you should recognise that 4.7 million over 5 years from the time that it is actually up and running, and clients of the customer are on the system and using it. Now, they said, well, hang on a minute. Last year, under the old standard, we recognised some of this because, we've been paid to do the data migration save. So we had to do an adjustment to pull revenue out of last year and spread it across the next 3 years. The client said, well, isn't that terrific? We've already reported 1.2 of revenue. Now we're going to report that 1.2 again over the next 2 or 3 years. That means we've got 2.4 million of revenue. And they thought that was a pretty cool thing, which is exactly how it's going to come out. There is an adjustment to retain earnings, but as far as profit's concerned, they're going to recognise more profits. So they were really excited about that. But it is just making mirrors. It doesn't give them any more to spend. But then the question comes, so you with me on this so far? You've got to really identify what the performance obligation is, right down to the nitty-gritty. And we even talked about what the programmers are doing through development and testing. And was that updating the software? What happens in 6 months' time when we update the platform? Is that a special performance obligation? And the answer was, well, no, if we don't update it, it'll be out of date in 3 weeks because all the other things around it are changing, and therefore we have to keep it moving. So it's really just maintenance. It's not a new product that they will have. So we had to take all that into account. So we thought, okay, we've got the accounting side of this sorted out, but that took a lot of thinking. Now, this is one contract. This client has 37 other contracts for similar types of things, and they're all different. So there's a lot of work in that. But then Joel comes along and tells me, well, you got paid 1.4 million in December for initiation and scoping. Do you have to pay tax on that? And Joel, what would you say?
Yes.
Bugger. So you're going to be paying tax on something that hasn't hit the profit yet. And that's never a good thing. So be really, really careful that you don't forget this in adjusting your revenue. Everyone used to keep 2 sets of books, one for the tax man and one for the real set. Well, the reality is that's what you'll be doing now. There will be a different set of books on your revenue for the tax man and a different set for financial reporting. And the same thing follows over into your leases. You will be keeping a set of books showing leases as rental deductions, generally, but financial reporting you'll have another set. And as Carmen said, the management accounting side of it, how are you going to do that? I was talking with a client yesterday, he's got lots and lots of bonuses to 27 branch managers that are based on profit from the branch, which includes the rent. So this particular client said, well, we're going to keep management accounting as we have done before and set up another division called Lease Adjustment Division. We're going to put all the lease adjustments in there so that we don't have to go and work out what the new profit should be for the bonuses for all the branch managers, because that's just too hard to figure out. In future, as people get used to the new, maybe they'll do it, but in the beginning, that's how they're going to do it. So, big decisions for you to make. This particular client is a junior end, they're just doing their budgets for next year, so they have to answer all of these lease and revenue questions before then, so they know how to do the budgets, not just to do financial reporting. And if they need to go and change branch manager bonus agreements, they've got to do it before 1st of July, otherwise the branch manager is saying, hang on, you can't change it halfway through. So, just a couple of practical things there for you to think about. Has anybody got any questions for Michelle, Joel or Carmen about the stuff we've talked about this morning? Right, okay, you're all eyes, you've all got a million questions. Make sure you talk to your HLB contact sooner rather than later. With all of our audit clients we're talking to now about planning for this, we'll be looking for you to have completed the 5-step revenue template and have it ready. You really should take this through your board because these are policy decisions, and the same for the tax. When you're budgeting your tax, you should be taking all this into account. On the leases, as Carmen said, it's a bit vague about what the low value is. We're suggesting to you that 10,000 Australian dollars is your spot for your low value assets. And for those not-for-profits in the room, you haven't got just 15 to deal with, you've got 1058 to deal with, and there's a real decision tree to work out which one you have to comply with. We produced a template that I'm very, very much hoping we'll send out this week to our not-for-profit clients to say, here's a template to work through that. It really, really does make it a lot easier for you to figure out where you've got to go on the whole income recognition for not-for-profits. If there's no more questions, I want to thank you guys for coming on, but maybe you can join me in thanking Carmen, Michelle and Carl for their presentation. Now, as I said, talk to your HLB contact, make sure you got this, even if you think it's right, as Carmen said, or it was Michelle. Lots of people saying, doesn't impact on me. Whoops, it probably does, so you better find out sooner rather than later. We'll see you all again in 6 months' time when we do this again, and you'll be able to tell us about how you've all dealt with it and the lessons you've learned, and maybe give each other a few tricks on that. So thank you very much for attending today. Enjoy the rest of